You have $10,000 in your bank account. You can see it in the app, on your statement, at the ATM. It feels completely real. But out of that $10,000, only a tiny fraction exists as physical bills somewhere in the world. The rest isn't sitting in any vault. It isn't stored anywhere. It's literally a number in a database that was created out of nothing seconds, months, or years ago, the moment someone took out a loan. The financial system that moves the entire planet runs on money that, for the most part, never existed as anything physical. And we're about to understand exactly how. Most people imagine the banking system working like this. You deposit your money at the bank stores it in a giant vault, and when someone else asks for a loan, the bank lends them that same money you deposited. It's an intuitive picture, it's tidy, and it's practically false. In reality, when a bank approves your loan, it doesn't check its vault to see if it has enough cash on hand. It simply writes a new number into your account. That money didn't come from anywhere. It didn't move out of someone else's account. It was created at the exact moment the bank approved the loan. Here's what that actually looks like. Say you walk into a bank and ask for a $20,000 loan to buy a car. The bank doesn't pull $20,000 out of a stack of cash someone else deposited. It types 20,000 into your account. That number is brand new. It didn't exist 5 minutes earlier, anywhere, in any form. And yet, the moment it appears on your screen, you can spend it exactly like any other dollar. At the dealership, at the grocery store, anywhere. This is called debt-based money creation, and it's the mechanism behind most of the money circulating in the world today. Here's the number that breaks most people's intuition. In economies like the United States or Colombia, more than 90% of the money in circulation isn't physical cash. It's digital money that exists only as accounting entries between banks. The bills and coins in your pocket are just the tip of the iceberg. Everything else, the overwhelming majority, is numbers moving between servers, backed by debt, trust, and regulation, but not by gold, silver, or anything you can actually touch. This isn't a fringe theory or a conspiracy. It's exactly how central banks themselves describe the system when they explain how it works. Bank credit is the main source of money creation in modern economies. And it wasn't always this abstract. For most of modern history, money was at least loosely tied to something physical. Gold. Under the gold standard, a country couldn't print more currency than the gold it actually held in reserve. Every dollar was, in theory, a claim on a fixed amount of gold sitting somewhere in a vault. That system collapsed for good in 1971 when the United States fully cut the dollar's last remaining link to gold. From that point on, money was backed by nothing physical at all, only by trust in the government and the banking system issuing it. That single decision changed how every currency on Earth works to this day. Here's where the story gets interesting. If money is, at its core, a collective agreement and not a physical object, why does it work? The answer is that money has always been this, even before digital banks existed and even before gold, seashells, carved stones, even gold itself. None of that had real intrinsic value. It had value because a large enough group of people agreed to accept it in exchange for goods and services. Money was never the thing. It was always the agreement about the thing. The only thing that changed over time is how physical or abstract the symbol representing that agreement is. From shells to metal coins, to paper bills backed by gold, to numbers on a screen backed by nothing but trust. What holds the entire system together isn't that money exists somewhere. It's that millions of people every single day act as if it does. And this has an uncomfortable consequence. If enough people stop believing in the agreement at the same time, the system starts to shake. This is exactly what happens in a bank run. When many people try to withdraw their money at the same time, the bank discovers it doesn't have anywhere close to enough physical cash to give everyone back their money, because that money never existed as cash in the first place. It only existed as trust. This has happened again and again throughout history, from small local banks to entire national banking systems collapsing in a matter of days. Once enough people simply stopped believing the numbers on their screens meant anything. That's why governments and central banks put so much effort into maintaining that trust. Deposit insurance, regulations, central banks acting as lenders of last resort. They're not protecting mountains of cash. They're protecting a collective agreement that, if it breaks, has nothing physical behind it to hold it up. Next time you check your account balance, it's worth remembering this. That number doesn't represent a pile of bills waiting for you somewhere. It represents trust, measured in figures. That doesn't make your money any less useful or any less real in the way that matters. You can spend it, save it, invest it, and society as a whole will keep accepting it tomorrow. But understanding that money is, at its core, an agreement and not an object changes how you think about debt, banks, and why financial crises often feel less like a shortage of real resources and more like a crisis of confidence. In the end, money was never about what you have stored away. It was always about what all of us together decided to believe.